You're listening to The Capital Table. Private capital markets have been evolving for many years, but never more so than in recent times. Take a seat at the Capital Table with leading experts discussing insights into the private equity and M&A worlds, and take away the knowledge you need to excel in a rapidly changing marketplace. We know this is one table you'll leave feeling full and satisfied.
Hello, everyone. Welcome to another edition of the Capital Table as we have an initial discussion on the important and continually growing category of private equity, that being independent sponsors. I'm very excited to have with us today Paul Marino of Sadis and Goldberg. Paul's firm, like Witham, has a number of independent sponsor clients, and Paul has a wealth of knowledge on this important topic. So welcome to the Capital Table, Paul.
Well, thank you so much for having me today, Steve. I'm very excited to be here, and certainly this is a growing space that continues to build momentum. So excited to speak to you about it.
Yeah, great. Yeah, and you and I have had a number of discussions. Again, we have a lot of clients in this space, so I think for this edition, let's cover some of the groundwork on independent sponsors for our audience, and certainly just starting off with what is an independent sponsor.
Sure. So an independent sponsor is, generally speaking, it's an individual or more likely a team of people. And why a team more likely is because investors generally, especially as the independent sponsor starts to gain momentum, if you will, and start to invest more, an investor is more likely to invest with a team of people rather than an individual. So let's just say it's a team of people who invest in and raise money for a specific transaction, as opposed to a pooled investment vehicle that has raised capital through investments and commitments for a number of transactions, thereby benefiting from the portfolio effect, if you will. And again, most people, I guess back in the politically incorrect days, most people would think of independent sponsors as what they used to be referred to as fundless sponsors. So it's really or some people call them a search fund.
Yeah, that's great. And I know certainly, many of the clients I have that fit this category were with bigger firms, left, started their own thing. But I mean, who are the individuals you're seeing that are prevalent in forming these independent sponsor teams?
Sure. So I'm going to just, broadly speaking, I'm going to group it into two different buckets. The first bucket is going to be the senior professional. So the senior professional, let's just call it's a group of senior, generally out of PE professionals who leave a fund after a number of years. And, they're just kind of tired of the relentless fundraising surrounding that goes with having a fund, or the amount of compliance and investor relations that goes with it, and especially with a time lag in payment, right? So when you have these senior guys that are looking to build out or leave these PE funds, what they see is they're very hyper successful. They've started their own funds, maybe run 2-3 funds, and they still enjoy doing deals. And they have a cadre of investors that follow them. And as a result, it's easier for them to go out and raise capital on specific deals. And what you'll see is they're not necessarily generalists. They are, generally speaking, they are laser focused in an area. They know the area well, and their investors know that they can provide them with a return. So those are our the senior professionals, and generally they're not looking to start a new fund, a blind pool, if you will. Then our second group are the junior professionals. The junior professionals, like the senior professionals, they come from a PE firm. Generally speaking, they're from a larger place. They have experience, but not, the vast experience of running a fund. They've also not really been able to really benefit from the carried interest from fund 1, 2, 3, or 4 that they've left, and they're now looking to kind of cash in, if you will. The junior professionals, what they're running into is that it's very hard right now to raise a fund as an emerging manager, right? I mean, it's just a difficult market. It was difficult before, it was difficult before you had this whole COVID issue. The COVID, has made it even harder. And I would say it's been difficult to raise capital as a first-time manager all the way back through kind of post-Madoff, right? So they're out looking for one deal, two deals, and they'll start generally at a smaller dollar amount. And they're looking for they're looking to parlay this into a fund, right? So they want to take their experience, their one or two deals, build a track record, and parlay it into a fund.
Yeah, certainly similar experience what we're seeing in our client base and those we talk to in the industry. So it really is a really interesting category and some great successful professionals who are seeing this vehicle as an avenue for doing deals. As you said, at the end of the day, these are people who like to get deals done and then obviously make them successful afterwards. And we both said in our opening comments how this is continuing to gain traction. So why do you think and what are you seeing that makes the independent sponsor business model continue to gain this momentum? You touched on fundraising, but other issues you're seeing out there.
Yeah, so that's a great question, and one of the reasons why you're seeing this is because of fundraising. It's also the dynamics of the underlying investor. 10 years ago or 15 years ago, you would have institutional clients, whether they were an endowment, but more likely some type of muni fund or what have you, and they would be more apt to invest and cut a check of 10, 15, $20 million a clip into a fund. But now, when you mix the difficulty in raising capital in today's highly institutionalized and segmented marketplace, it's very difficult for a sponsor to go to an institutional investor and ask them for anything less than maybe 50 million. And when you really kind of look at it and you want to, let's say we want to, Steve, right? So let's say you and I go out and we're sponsors and we want to create a fund that's just $250 million. And if we went out to a number of, large institutional investors, they're generally stuck on ticket sizes no less than, let's say, 50 million, 25 to 50 million, but they also have concentration limits. So that's, 50 million, let's say, at 10%, my fund has to be a minimum of 500 million. So all of a sudden, those institutional investors are knocked out of the box. And then you go down to endowments, and endowments, generally speaking, might have a more conservative approach, or they're looking for more fixed income type of assets or fixed assets. So then, when you kind of start crossing out these institutional investors, who do you have left are really family offices. And even then, family offices really don't want to be in pooled investment vehicles anymore. I mean, they're really looking instead to direct deals. So little institutional, you mix this with very little institutional investment support, a pull away from pooled investment vehicles by family offices into direct investments, you have an increase in this independent sponsor pool. And that's not to say, Steve, I don't want to say that there's no more $250, $500 million funds out there, and let's call that middle market. But a lot of those funds are legacy funds. They've been in the marketplace for a long time, and they're just rolling in, fund 1, 2, 3. There's one locally here in Connecticut that I could think of that's on fund number 7, and they just raised $750 million. But traditionally they've been about 250. So I think that it's really it's kind of a cause and effect, and it's really as a result of a lack of capital providers in the space.
Yeah, those are great insights, and certainly we've seen this shift in the institutional investors, the endowments over the past decade, and the emergence of more family office type structures, and Again, certainly I think we can explore that topic a little more, but if you look at the structure of the independent sponsors, that provides a different, level of benefit by the structure to the independent sponsor, to the investors, and ultimately the sellers and the portfolio companies afterwards. But really keeping that broad statement I made a little more focused, what are the benefits you're seeing of the independent sponsored structure?
Sure. Well, I mean, the first and foremost for the investor, I mean, for the sponsor and their point of view is that you have immediate netting. So you can, you get all your fees out right away. And then when the deal is done, assuming you had a positive outcome, you can collect your carried interest right away. You're not waiting 7 years and there's no clawback or anything else. For the investor, it's the same thing. I mean, generally speaking, a lot, these deals are 2 to 3 year, 5 year at the most life cycle deals. And, you can really see the results of your transaction right away. And you know what your fees are going to be, right? So, as an investor, you see it right away. You get to invest right away. Most of these deals have a co-investment kind of aspect to it, especially for a larger ticket family office, right? That strokes a bigger check. And and that structure in and of itself lends itself to, again, the trend in family offices to co-invest. And for the sponsor, they get almost immediate satisfaction, if you will.
Yeah, and certainly the ability to see that speed on return and investment as the world shifts is really important. And and I think you've covered the categories of who is investing in independent sponsors, but if you broke it down, is it mostly family offices within your client base that are investing in independent sponsors, or are you seeing any other category of investor that's tagging along on these deals?
It's a great question, and here's what I would tell you is I do think mostly it's family offices or super high net worth individuals, but you know who else is coming into this space more and more are very large private equity firms, because they're running out of deal flow. The independent sponsors are not they're not salesmen, if you will, right? So they're not just out there beating the bushes and providing deals. They're doing a lot of the underwriting, due diligence. They're so they're really kind of a knowledge base that is untapped, and for a private equity firm that needs to put a lot of money to work, right? Think of any large Blackstone, you name it. I mean, they need to put money to work, and they need to get sector specific, and it's very difficult for them to be able to crawl through that, through thousands and thousands of deals. But with the independent sponsor, you have an expert, generally speaking, somebody that is one of your peers, right? Whether they came from sell-side banking or more likely from a large private equity shop, you have an expert in the space that can get granular in a specific, in a specific vertical. And boy, man, I mean, you could save these private equity funds a lot of time and effort and money. So you'll see a deal sponsor with a financial sponsor more than you've seen before. I mean, we've done deals just like that, where right, Steve, that somebody brings you a deal and you're a large PE firm, then you decide, hey, I like this a lot, I'm going to come in for this much money. You just have to deal with our reporting requirements, but you can still run the deal.
Yeah, that's an excellent point, and I have certainly seen that with my clients, and some that have been independent sponsors for a number of years, and kind of to your point, started in that business, and they had their pool of investors and the high nets, and grew into a little bit of bigger family offices, but have absolutely seen right on point with what you're saying, that you get a deal in a certain sector, and they know the larger private equity firms that like that sector, and it's the opportunity for them to deploy capital. They already know the sector, and the independent sponsors obviously done all the legwork up front to get the deal in-house, to get it under LOI, to understand the business, and oftentimes done the diligence, and it's a shorter path to deploy capital for those private equity firms. So
yeah, and don't forget all the players in the business as well. I mean, that it's a huge part of it, right? I mean, they know where all the bodies are buried. It's a big part of how they're doing business.
Yeah, absolutely. Well, Paul, it's been a great discussion, and I think we've only scratched the surface of independent sponsors. I think I certainly foresee part two of this topic coming up for us on the Capitol table. So, absolute pleasure having you with us today. Great points you made, and again, for our audience, this is a topic we'll continue to explore. Certainly invite Paul live here on the Capitol table to rejoin us as we continue to talk about certain aspects of the independent sponsor model and how it impacts and can be a benefit to sellers. There's pros and cons, of course, but I think that's one aspect of this that I see as I'm alongside with my clients who are independent sponsors, their ability to really present a different solution for a seller. Again, a topic for us to explore down the road.
It's a great point, Steve. I'll tell you right now. I mean, a lot of clients feel more comfortable selling to independent sponsors than they do private equity for a host of reasons. But that is a great topic.
Yeah. So we will explore that down the road, Paul. Thank you today for your time and your insights, and thanks to our audience for tuning in.
Thank you so much. See you, Steve.
You've been listening to the Capitol Table. For more information, please visit withum.com. Thank you for listening.